The FinTech industry is booming with investments of more than $5 billion in just the first quarter of this year alone. And this morning, the first ever summit between banks, startups, and the administration discussing FinTech is taking place at the White House. Joining us now is Charles Moldow from Foundation Capital, who is participating in today's summit, an early backer of Lending Club and On Deck. And Charles, it's good to see you again.
Good seeing you as well.
We saw you yesterday in Palo Alto before our shot went down. You are now in D.C. for this summit. We'll pick up our conversation from yesterday in just a bit, but tell us how the table's been set for today's conversation in Washington.
Sure. There's been a lot of conversation this week across multiple organizations related to the government, the FTC yesterday, CFPB, and today it's the White House. So we're looking forward to hearing the White House's take on innovation in FinTech and how they plan to support it.
There have been a lot of agencies raising their hands in sort of a Me Too manner when it comes to figuring out how to regulate this sector. Who do you see doing the best job?
So far, the White House's posture has actually been the most positive in terms of trying to embrace innovation and trying to understand how we can utilize innovation to benefit the public. It seems to me a little bit that the other organizations are more watchdogs trying to figure out what's going wrong rather than what's going right.
FinTech can mean everything, though, from processing payments to running a digital wallet to making small business loans. And I'm wondering if you think that any part of the FinTech sector needs regulation sooner than others.
Well, I think anything that controls consumers' money obviously needs more protection than when it doesn't. And so to me, anything maybe on the wealth management side is probably the area where you might want to look most closely as compared to, let's say, remittances or the lending space. Predatory lending, of course, is bad, but really that's in the subprime space. You had mentioned Lending Club. That's not a space that Lending Club plays in, for example.
But we have seen a lot of small businesses, a lot of consumers, when they either get turned down for a loan from a bank or they just want to exclude the bank from the process altogether, they've been going to alternative lenders. How is that trend shaping up? Where is the safest place for someone to get a loan outside the banking sector right now?
I would say for anybody who's a prime consumer, those that are in the economy with good FICO scores, there are a tremendous number of alternatives, and they're all quite safe. The predatory lending is really for things like payday lending and check cashing, but putting that small subsegment of the industry behind, and that's only maybe 3 or 4% of the industry, the other 95% is quite safe and provides consumers with a really strong value proposition of good choice, transparency, ease of use, and much lower rates.
We spoke yesterday about Lending Club, about the declining confidence in the business, at least from Wall Street's perspective, judging by the stock price. But you were telling us yesterday, before our conversation ended, that you think that it is more of a blip on the radar rather than a more longer-term event for the industry. Tell us a little bit more about where you're coming from and how you think that situation plays out.
Sure. It's really a difference between corporate governance, let's say, on one hand, and the product on the other. In the case of Lending Club, the product is an incredibly sound product. You have borrowers receiving rates that are 500 or 600 basis points cheaper than their alternatives, and they're saving that money, putting it into rent and food and other necessities. On the other side, you have lenders who are making hundreds of basis points return better than their alternatives. That's a great product. That product deserves to exist. Corporate governance, on the other hand, is something that the board is trying to address in their actions. I think about maybe the HP activity 4 or 5 years ago where they were doing backdating of stock options. It said nothing about the chips that went inside computers or the computers that HP was selling. That was a fundamentally good product. There was a corporate governance issue. When that issue got resolved, people kept buying the product because fundamentally it's a good product. I think it's the exact same case here.
So if there are no problems with the fundamentals, the stock being down 81%, Foundation a 7% holder, would you help the founder do a management buyout? Is that what you think is the best option, to go private and figure out these issues behind the scenes?
Well, you could certainly argue that taking the company public a few years ago maybe was the largest mistake because it narrowed the ability for them to move with freedom with respect to new product development and the growth rate that they were pushing the company at. Whether the company stays public or goes private, I think is a very attractive opportunity. Of course, we'd have to look at every alternative, but right now we are very big believers in the long-term opportunity of the stock. Yesterday I mentioned Netflix. I remember sitting at a partner meeting where the stock was at about $3.40, and we were really worried about Blockbuster taking the company's business away. But fundamentally, it was such a good product offering, and the management team was so strong, as in the case of Lending Club here, that we feel like, you know what, you have to hold for the long term because it's a great business.
Yeah, we've become very familiar with that blockbuster Netflix anecdote. Before we go, Charles, Silicon Valley obviously in mourning for Tom Perkins, legendary venture capitalist, founded Kleiner Perkins, and you knew him. Tell us a little bit about your relationship with Tom, about the Valley's remembrance of him today.
Yeah, you know, he was definitely, 2 generations before I entered the venture business. So he was really one of the foundational people that created the industry back in the 70s. My fondest memory was when my partner Paul Holland filmed a documentary about the venture capital industry called Something Ventured. And Tom Perkins was featured in the documentary quite extensively. And he was interviewed in the cabin of his yacht with his big, bright ascot. And you could see in the back windows the yacht was kind of floating. You would have not known it was a yacht. It was such a big space. And it seemed at that time he was enjoying life and enjoying the fruits of his labors and building the venture capital industry in the 70s. He will definitely be missed.
He has gotten so many companies off the ground thanks to his funding. He will be missed. Charles, we wish you well in D.C. Safe travels back out west and have a great weekend.
Thank you, and you too.
Charles Moldow from